The MGM Grand Detroit Casino opened in October 1999 as one of 3 permanent casino facilities authorized by the city of Detroit following the state of Michigan's approval of commercial casino gaming in the city in 1996. Detroit's casino authorization was a product of a specific political moment. A city whose industrial economic base had been contracting for 4 decades, whose population had declined from approximately 1.8 million in 1950 to approximately 1 million by the late 1990s, and whose fiscal capacity for public services was being progressively reduced by the economic contraction, had determined that casino gaming revenue represented one of the most accessible mechanisms for generating tax revenue without the political complications of raising rates on a declining tax base. The MGM Grand Detroit was developed by MGM Mirage and its Detroit-based partner, Greektown Casino's development entity, at a cost that the final facility opened in permanent form in 2007 after an extended temporary facility period, placed at approximately $800 million. The permanent facility's construction financing reflected the Detroit commercial real estate market's specific characteristics in the mid-2000s, a market whose declining industrial base and contracting population had produced commercial real estate valuations that made the MGM Grand Detroit's construction financing challenging to assemble at terms consistent with the projections that the project's revenue model required. The forensic entry point for this case is the relationship between a casino's gaming revenue model and the specific economic characteristics of the market it serves, because the MGM Grand Detroit documents the proposition that a casino resort whose revenue model was designed for the Las Vegas Strip's national and international tourist market can be financially stressed in a local gaming market whose customer base is constrained by the specific economic conditions of a post-industrial American city. The house of cards that the title references is not the MGM Grand Detroit's gaming floor. It is the financial structure that was placed on a gaming asset in a market whose economic constraints made the Las Vegas scale investment thesis difficult to validate. If this is your first case file from this channel, subscribe now, because every episode adds one more layer to what you are about to understand about the architecture of institutional failure. The MGM Grand Detroit's financial structure in the period following the permanent facility's 2007 opening reflected the specific challenges of operating a large-scale casino resort in a market whose customer base was experiencing the most severe economic contraction of any major American city. Detroit's automotive industry crisis of 2008 and 2009 produced unemployment rates in the metropolitan area that at their peak exceeded 20%, a demand destruction for discretionary gaming spending that was significantly more severe and more sustained than the national recession that affected every gaming market simultaneously. The covenant structure governing the MGM Grand Detroit's construction financing required the casino to generate net operating income at levels that had been projected on Detroit's pre-crisis economic baseline, a baseline that the automotive industry's collapse had made obsolete before the permanent facility had been open for 2 full years. The specific financial stress that the MGM Grand Detroit experienced was not primarily a function of operational failure. The casino was well managed by the standards of the industry and consistently generated positive EBITDA from its gaming operations. The stress was a function of the gap between the debt service obligations that the $800 million construction financing had created and the net operating income that a gaming market serving a severely economically distressed customer base could generate. The Detroit gaming market's customer base was not expanding with the national gaming market. It was contracting with the Detroit economy. The customers who had been the MGM Grand Detroit's primary revenue generators before 2008 were facing unemployment, reduced income, and the specific financial anxiety that automotive industry workers experienced when the industry whose wages had supported their discretionary spending collapsed. Gaming revenue is a discretionary expenditure. Discretionary expenditures are the first category eliminated when household income contracts. The MGM Grand Detroit generated positive gaming revenue through the crisis. The gaming revenue it generated was insufficient to service the debt whose terms had been established before the crisis made those terms unsustainable. At what point does a casino resort's financial structure need to incorporate a market-specific economic stress scenario for a customer base that is concentrated in a single industry sector? Leave your analysis in the comments below. The appraisal methodology that governed the MGM Grand Detroit's construction financing shared the foundational error this channel has documented across its archive, but expressed it through a market-specific economic concentration risk that previous case files have not examined with this precision. The stabilized revenue projections for the permanent facility were calibrated to the Detroit gaming market's performance trajectory in the period between the temporary facility's 1999 opening and the mid-2000s, a period during which the Detroit economy had been contracting gradually rather than catastrophically, and during which the gaming market had demonstrated revenue growth consistent with the national gaming industry's expansion. The projections had not adequately modeled the specific vulnerability of a gaming market whose customer base was concentrated in a single industry sector, whose economic trajectory was deteriorating independently of the national economic cycle. Detroit's gaming revenue was always more vulnerable to an automotive industry crisis than to a generic national recession because the automotive industry's employment levels were the primary determinant of the discretionary income that the Detroit gaming market's customer base had available. The appraisal had modeled a stress scenario based on a moderate national recession. It had not modeled a scenario in which the primary employer of the gaming market's customer base experienced a 50-year low in production and employment simultaneously with a national recession. The MGM Grand Detroit's lenders, recognizing the casino's genuine operational quality and its strategic position as one of only 3 licensed gaming facilities in a major American market, engaged in a series of debt modifications, covenant waivers, and refinancing arrangements that allowed the casino to manage the debt service shortfall without filing for bankruptcy. The negotiated debt modifications preserved the MGM Grand Detroit as an operating entity through the crisis period. They did not resolve the underlying structural tension between a Las Vegas-scale investment and a Detroit-scale economic recovery trajectory. The casino has continued to operate and has progressively rebuilt its financial performance as the Detroit economy has partially recovered from the 2008 crisis. If the forensic analysis this channel conducts is changing how you read real estate headlines, the like button is how the algorithm knows to send this case file to the next analyst who needs it. The MGM Grand Detroit's management of its financial distress through the 2008 and 2009 crisis reflected a pattern documented across this channel's archive with a specific institutional characteristic: the willingness of a large institutional operator to absorb short-term financial losses on a specific asset rather than allow the asset to fail in a way that would damage the operator's broader institutional reputation and its relationships with the regulatory and political environment in which it operated. MGM Mirage's decision to support the MGM Grand Detroit through the crisis rather than allow a bankruptcy filing reflected several specific institutional calculations. The regulatory relationships that a major casino operator maintains with state gaming commissions across multiple jurisdictions make a single property bankruptcy filing significantly more costly than its individual balance sheet impact suggests, because the reputational and regulatory consequences of a bankruptcy in any jurisdiction affect the operator's credibility in every jurisdiction where it holds licenses. The Detroit political environment had invested significant political capital in the casino gaming authorization of 1996, and the failure of a major licensed casino would have imposed political costs on Detroit's elected officials, whose relationship with MGM had been a condition of the gaming authorization's successful execution. The institutional denial in this case is therefore distributed between the lenders and the operator in a pattern that differs from most case files in this archive. The lenders denied, through the covenant modification and waiver process, that the debt service shortfall they were tolerating constituted a financial failure that required formal acknowledgement. MGM denied, through its continued operational and financial support of the Detroit facility, that the market-scale investment thesis it had applied to a city whose economic trajectory made that thesis difficult to validate had produced a financial outcome that its analysts had not adequately modeled. Both denials were rational responses to institutional incentives that made formal acknowledgement of failure more costly than continued accommodation. The MGM Grand Detroit continues to operate as one of Detroit's 3 licensed casinos, serving a customer base whose economic circumstances have improved from the crisis period lows, but whose recovery trajectory remains constrained by the structural economic challenges that Detroit's post-industrial transformation continues to produce. The MGM Grand Detroit has operated continuously since its permanent facility opening in 2007, serving as one of 3 licensed casinos in the city of Detroit, and as a significant contributor to the city's gaming tax revenue. The casino's financial performance has been managed through a series of debt modifications, refinancing arrangements, and capital structure adjustments that have allowed the facility to service its obligations without a formal bankruptcy proceeding, a resolution that the cooperation of its lenders and the operational support of its parent company made possible. What the MGM Grand Detroit case reveals, in the context of this channel's 51-case archive, is the specific category of financial stress that arises when a Las Vegas-scale investment thesis is applied to a local gaming market whose economic constraints make the revenue generation assumptions of that thesis structurally difficult to achieve. Las Vegas casinos survey a national and international tourist market whose customer base is not concentrated in any single geographic or economic area. A decline in demand from any specific customer segment is partially offset by continued demand from other segments. Detroit casinos serve a local market whose customer base is concentrated in the Detroit metropolitan area's economy. A decline in the Detroit economy is a decline in the casino's customer base without the geographic diversification that would allow offset from other segments. The investment thesis that justified the MGM Grand Detroit's $800 million construction financing was calibrated to the national gaming market's economics. The specific local market it served had economics that differed from the national baseline in ways that the appraisal methodology had not adequately captured. The casino survived the mismatch through lender cooperation and operator support, rather than through the revenue performance that the original financing structure had required. The house is still standing. The cards that supported it were shuffled rather than withdrawn. If this case file changed how you evaluate the relationship between casino financing models and local economic concentration risk, subscribe, because the next case examines a gaming market whose economic constraints were not automotive, but regulatory. And in the comments, given the Detroit gaming market's demonstrated vulnerability to automotive industry employment cycles, what specific underwriting adjustment to the MGM Grand Detroit's construction financing would have most effectively addressed the local economic concentration risk that the national gaming market appraisal methodology had not priced? The case file is open. This content was developed using artificial intelligence tools as part of the research, writing, and production process. All AI-generated material was subject to human review, editorial intervention, and approval before publication. Factual claims, interpretive framing, creative direction, and final content decisions reflect human judgment throughout. This disclosure is provided in accordance with platform transparency standards for AI-assisted content.